why don't you take it away?
Cool. Yeah. So let me get on my share screen here. And I'm going to be doing some flip-flopping between share screens here. Just to show you guys some different stuff. This is kind of, I don't know how big or small that is. This is kind of high level of how I do my cash flows. And I know, Dave, you've got your tool that we can kind of implement the cash flow. This is the way I calculate things. We can implement it into that tool. I didn't want to carve up the tool too much without kind of going through a refined process on it. I normally just kind of set up a spreadsheet like this and run my cash flows. And this is just kind of a high level we're going to be going over today. It's just going to be the business cash flow side. There's going to be the business cash flow side and the personal cash flow side. This applies, we've got 1065 tax returns, 1120, 1120S, and in some cases we've got clients filing on a Schedule C. We don't see that very often, but all these are kind of universal. It just kind of changes the place and where you're looking for the information. But what our goal is to identify cash flow, not taxable income, because we can just grab a tax return and see what the taxable income is. That's not what cash flow is. Taxable income is basically what at the end of the year, what is the client responsible to pay taxes on? That's going to be hit by deductions, expenses, money moving around. It's not cash flow. Cash flow is actually when we look at the tax returns, we can kind of pick it apart and see what is the actual money that the business received or throughout the year. So that's what we're trying to identify as cash flow, not income per se or taxable income. And I'm going to flip over here to an actual tax return. See if I can make this work. Okay. And I'll send this out to you guys afterwards so you can have it kind of in writing, because I'm going to be kind of flip-flopping. It's, we need the visual aids on this one. But basically, the first thing we're going to be doing is we need to identify the actual reported income per the books, which that is something that we get from a Schedule M. Now, so we're looking at a 1065 tax return, and on a 1065 tax return, we would look at a Schedule M1 or Schedule M, which, if we scroll down to here, we can see net income, M1, line 1, net income loss per books. That's the amount we want to capture for the actual income for the business. We don't want to take it from that first page on a 1065, which we go back to here. We can see they also have it on here as at the bottom. Ordinary business income and loss. We don't want to use that. Reason being is that's just what's reported for the actual income, for taxable purposes. On the Schedule M1, it's going to include things, and it's normally lower, but there's deductions that they can't take. One being, off the top of my mind, is like meals and entertainment. They can only take 50% of that. It's an actual expense. They can only claim 50% of it for the tax purposes. So that's why we use the actual net income or loss per books off of here. If we want another example, if we go to this is 1120S. So ordinary income business on the front page of an 1120S. We don't want to use that. We're going to go to, this is 1120S. M1, very similar. We're going to use that net income loss per book. So that's where we want to start. That gives us the starting point for the income. The next thing that we want to go and look for on the tax turns, we're going to actually go on the, and I'm going to kind of stick to the 1065. You can see on the top left corner, here's the 1120S tax form. I'm going to go back to the 1065 tax form. The next thing that we want to include in our calculation. So let me go back here to our actual sheet. So, let's say we've got a business that made 200,000 in schedule line, schedule M line 1 income. The next thing that we want to do is look for the interest that they paid for the year. Now that is a valid expense, but basically what we do is we add back in the interest, because what we do is they can only expense the interest payments, so we want to hit them for the full debt payment in the debt section of our calculation. So basically what we do is we add back in the interest that they paid throughout the year, and then we're going to add back in the debt later on, and we'll talk about where we get that from. So if we flip back to our actual tax returns, anybody have any questions on this so far, or comments?
Yeah, I guess probably just a clarification too on the, I think you hit it, but just, for newbies that are watching this, that, whenever you have a debt payment, most of the time it's going to have a principal and interest payment.
Yeah.
And so the tax, the accountants can only take the interest from that principal and interest, which will add back the full principal and interest, but that's what you're adding back essentially. So that's it.
Yeah. So, I'm sorry, I might not have shared my screen there on this one. So, yeah, as I was saying, we capture the, basically we're going to add back the interest, and then below that we're going to add the full debt payment, which if it's an interest only payment they've got, we're probably adding back in the same thing. But if it's a principal and interest, then obviously adding, we need to be adding that principal payment back in also. So on that, what we're going to do is on the front page of the tax forms, this is a 1065 again, there's a line, and I can send you a list of all the lines of, find interest on line 15 of the 1065. I kind of advise not to get comfortable with that, because they revise the tax turns, and it's better to understand kind of where on the schedules and the forms to find the information, instead of knowing exact lines, because this stuff moves around. I mean, 1040 is a good example that completely reworked. So, again, add back the interest. The next thing that we're going to look for is depreciation. That's another one on the front page of the tax turn. Now, depreciation is basically it's just loss of value. That's why we add it back in. It's not an actual it's not impacting the cash flow. It's a tax write-off. Basically, if it's something like a building or equipment has a value of 100,000, and it depreciates by a certain amount, say 50,000 over 10 years. So they can take that 50,000 depreciation over 10 years, and each year they take a portion of it. That's what depreciation is. It's not an actual monetary loss. It's purely for accounting purposes. So it can be captured here on the front page of the 1065, or on the front page of like a 1120. It's going to be on there also on the front page. It does also show up again on the Schedule M. So if we look on here on the Schedule M, depreciation gets captured on there. I've always taken it from the front page is where I've always looked for it. I don't know if there's any reason not to do that. but front page is where I've always looked for it. The other item that's similar to depreciation is going to be amortization. Go back to the front page here again of our 1065. Now, amortization is basically loss in value of a non-tangible asset. So money lent, something like that, something liquid, not something non-tangible. It's loss of value over time. That does not show into an actual form. There's no depreciation line or amortization line on the actual tax return. So again, depreciation, but no amortization. So basically what happens on that is it goes under other deductions and it gets attached as a statement. So whenever you have a tax return and you see other deductions attached statement and there's an amount in there, you need to hunt through the tax returns. Unfortunately, it's normally at the end, and it'll have like a statement, 1, 2, 3, or statement A, B, C, and I'll say other deductions, and you need to read through that list and see what's on there. There'll be a line. There may be a line for amortization. There may not. It's normally not a large deduction. It might be a few $1,000s, but it's something that we want to include because, again, it's not a actual monetary loss. It's purely for accounting purposes. So that's something we would add back in. The next item that we'd want to add back in, or not really add back in, but it's really a takeaway, is distributions. And distributions are, let me go back to our form here so we can kind of see where we're at. So, so we would add back in interest because we're going to be taking out later. We're going to be adding back in depreciation because it's a non-monetary loss. Same with amortization, both only for accounting purposes. And then distributions, that's distributions to shareholders. And basically what that is the corporation is taking money from their capital accounts and distributing it to the partners. The reason that they do this is the tax liability for the businesses falls on the partners. The business does not pay taxes. So the corporation, if you're a 100% owner of a business and you're going to report ultimately that corporation's income or that business's income on your tax returns, on your personal tax returns, you get hit for the tax liability. So what businesses do, they distribute income to an individual, so they receive it in their accounts and they can basically pay their tax liability. It's really the way it goes. That does not impact the income line. So on an 1120S, it does not impact the actual reported income or loss to the IRS, but it does impact the cash flow. So that's something that we want to be aware of. It's if they're taking large distributions, that's money that's not going into cash flow and it's negatively impacting the cash flow. So
yeah, basically, if you're a C corporation, you're not really taking distributions, you're taking dividends. If you are a S corp and partnership or something like that, what Tom is saying is exactly spot on. You're taking a cash distribution, so that's really a balance sheet item. It's not a P&L, but it is a cash flow issue because you're pulling cash out of the company. And so that's why lenders want to know what are the distributions, essentially. So,
yep. So for distributions, let's go back to our 1065. Distributions are going to show on Schedule M2 on the 1065. And you guys can see this form, correct? It's a good size on your screen and everything. Is that correct?
yes.
Okay. So it's going to show distributions, cash, and that's what we would be taking on distributions. The other place it's going to show up is it will show up on a K1. Now, the K1 is going to show the distribution to the individual. So it's going to show on the K1, we're going to see the name of the entity or the business, and then we're going to see the partner's name on it also, and it'll have their social address, all that good stuff. This will be basically their portion of the distributions received. So don't don't go to just one K1 and say, okay, there's 10,000 in distributions. You need to make sure you have all the K1s, and that you capture all of them if you're not taking it from the Schedule M2. So if to confirm that, basically, this shows the percentage of ownership for the entity that individual partner has. So basically, you want to make sure that you're adding those up and it equals 100%. So if you have 2 K1s and it equals 75%, you don't have 100% of the distributions. There's a missing 25%, and you need to find out who that is. Otherwise, you can take the cash distributions from here. Distributions in here in box 19, it would be there can be multiple types of distributions, and I think it would be labeled, I believe it's A. I can confirm that for cash distributions to individuals, but I can confirm that and send that out to everybody. So when, and you do need both pieces of this puzzle. For the business cash flow, you do need to know the total distributions, but when you start analyzing the individual tax returns, which we'll go over at a later time, hopefully next week, that's where you need to know the individual distributions, because that's something you need to account for on their personal side. In most cases, they're taking sufficient distributions to offset their tax liability, but they could be taking more, they could be taking less, and that's something that could impact their liability in the long run. So the K1s for each type of filing will look different also, so keep that in mind. I think on the 1120S, it doesn't actually have a spot specifically for distributions. I could be wrong on this one. I think it gets placed under other information. I've seen it in the past. I think it gets put under there, but it does get noted on the 1120 SK1, I believe. I don't know if does that sound correct to you, David? I'm not sure if I'm right on that one or not. I'm trying to draw from memory from seeing them in the
Yeah,
past.
that sounds right. So yeah.
Okay, and then there's also an 1120 K1, which I don't have a copy of in this document package, but it does reflect on there and gets marked as distributions. But it also shows on here on the M. This is the 1120S M2. It shows distributions on here also. So the next item that we would want to be looking at now, so we've got the distributions. Next item is going to be rent payments. This is something that we want to add back in only if the rent payment is going away. So if you have somebody who is, let's say you've got an industrial shop that is making widgets in their factory that they lease, and they're going to be purchasing the factory that they lease, they are no longer going to be paying the rent payment at that point. So that's something we want to add back in. Let's say it's a bakery that's leasing their location, and they're ready to open bakery location number 2, and they're buying it. They're not getting rid of their lease payment in that spot. So make sure you're not adding back the rent payment, because that rent payment will still be there in existence. But it is an add back that I've seen in the past lenders overlook that. So it's worth, if you've got a lender if your cash flow is good and your lender is saying it's not, that's worth investigating and make sure that they're, taking that into consideration.
I think the other thing too, Tom, just to add to that would be, they may have multiple locations. That rent payment may also be something different, like rental of equipment or,
Yeah.
so just make sure that you're really clear when you're talking to people about rental payments. Don't assume.
Yep.
So
Kind of got ahead of me there, Dave. But
sorry.
that's no, it's all right.
Apologize.
That's so.
You can send me to timeout.
So for tracking down your rent payment, it's going to be on the first page of your tax return. So this is your 1065, and on here it's rent, and it, like Dave was saying, it's all lumped together. So if you see this on here, there's a couple ways you can check it. Obviously, you can ask the client and have them send you a copy of the lease and know for sure. Another way is if you have a copy of their profit and loss, they will, those normally get broken out and it'll say building lease, property lease, property rent, something like that. And then they'll have a separate line item for equipment rent. So you can kind of just fact check it against that, still confirm with the client in the long run, just to make sure. You don't want to get down, into the nitty gritty of underwriting, 3 weeks in to discover that you were wrong and on your assumption. So, look at, this is all the pooled rent payment that they make. And again, it could be equipment rental. It could be that one time they had a big job and they needed to rent extra equipment to finish the work that they were doing. So it could still be a large rent payment in there. So just make sure you check. So that's something we would add back in, again, only if they are getting rid of the payment. If it's a one-time payment for equipment rental or something like that, really can't take that out. There might be some justification for it, but most likely not on the lender side. But if it's a building that they are purchasing or moving out of, add that rent payment back in, and it'll definitely help your cash flow. Don't miss that one. And again, on the 1120, same setup, just right there on the front page. So something to include. So that's it for the actual coming in cash flow. Now, the next step on this is going to be the debt section. This is information that basically you're not really pulling from the tax returns. These are from the other documents we get. So existing debt payments, these are going to be existing debt payments that are not being paid off by the loan. So if we're doing some sort of consolidation loan, you're going to want to be aware of that and make sure you're not adding in, the financing that's being paid off. But this is something you'd pull from their business debt schedule, and it's an annualized amount. So don't see that they pay, $1,000 a month for their equipment. You've got to hit them for the full 12K and annualize it. And that's taking care of the interest that we've added back in. So we're now accounting for the interest. The other thing that would also be included in that existing debt payment would be buildings. If they have buildings, that are on there, mortgages, things like that. We're not taking out for property tax or insurance up here. So make sure you're not double dinging them. If they give you a payment on a location that's principal, interest, taxes, and insurance, only take the principal and interest. Otherwise, you're hitting them for taxes and insurance on the debt and taxes and insurance from the tax returns. New mortgage payment. So this is the calculated loan amount that we have on the new debt they're trying to secure. If it's, make sure you're annualizing that. And sometimes you might not know what that payment's going to be. So ballpark the rate, but maybe err on the side of caution. If you think that you can get them at a let's say 5.5, maybe hit it with a 6% just to give it a buffer and it's stress test it. And then if they are purchasing a new building, new insurance and new property tax here, that's information we need to capture, because that is not something that is captured on their tax returns. Obviously, it's a new building. And I guess the rent payment, if they're renting something triple net, unlikely they're buying at that point. But it's normally a Walgreens or something like that that's doing triple net. They're not looking to buy ever, but most likely you're not capturing this insurance and property tax payment on the tax returns anywhere. So that's something insurance. Ask them. They should have done the legwork and the calculation. They should know what's going in. If not, they need to figure it out up front. Property taxes, that's something that you can find online, or through the offer memorandum that's on there too. So include that on an annualized payment. And basically, once you've got all that information, you can calculate the debt service payment. We'll just do a simple one here. If they've got a new mortgage payment coming of say they've got 200,000 in income and 150,000 in new mortgage payment, their debt service is going to be 1.3 times. We need them to be basically their income needs to be 1.25 times or greater of the debt. There might be some exceptions to that. SBA can work around that. There's some lenders that'll do a 1.2, but typically we want to see them at a 1.25 times historically, to show that they have the ability to cover the payment on the new building. The other section over here, P&L, it's basically the same information that we're going to be capturing. It's just on profit and losses, distribution and amortization are not included on there. Depreciation normally isn't included either. I have seen some P&Ls with depreciation on there, so often enough to include it on here. P&Ls, that's something where each P&L is going to be a little bit unique, a little bit different. And as far as the layout of them, typically though, income is at the bottom, and then you really need to read through and identify the items of interest, depreciation, and rent payments, and make sure that you're, if you've got a P&L through June, don't hit them for 12 months of existing debts. Make sure you're only using 6 months on your debt side to kind of go along with the same number of months that the P&L covers. And that will also give you, you want their debt service ratio coverage to be similar or better. Obviously over the 1.25 times, but if they're low, halfway through the year, find out why. It could be a seasonal business. If it's retail and maybe they make all their money at Christmas, that could be it. But it's something worth identifying if there's a trend where this is decreasing currently. I don't know if anybody has questions or anything else I can cover or go over.
I thought that was a great job, Tom. Very clear, very simple, very precise when it comes to business, tax analysis. And so I think that's really helpful for all of us. And so thanks for doing that today for Integrity Capital.